Welcome to my accounting classroom. I'm Sid Bundy. Today, I'll tell you the secret to T accounts and demystify debits and credits once and for all. Most introductory accounting students enter my classroom expecting to see a lot of math. But accounting really isn't a math class. Accounting is more like a history or database management class. Most of the math we use is represented by two very simple formulas and one great big T. Bookkeepers and accountants keep the records of individual accounts by entering numbers on the left and right-hand side of this T. Let's take a closer look. Sam has $5.50 in his piggy bank. He deposits 20 dimes. Then he removes 1 quarter. How much money is in Sam's piggy bank? If this was your third grade math class, you would currently be experiencing flashbacks to some word problem trauma. And you'd structure your answer something like this, or this. A T account is just another way to structure or write down a simple addition and subtraction problem. In this example, we can keep track of the balance in Sam's account by writing the positive amounts on the left side and the negative amounts on the right. We add the positives and subtract the negatives to get a new balance. He has money in his bank account, which means the balance is a positive number and is written on the positive side. In accounting, the cash account represents the balance and transactions from a company's checking account. It's the cash in the real bank, not bills and coins lying around or in the cash register. I said earlier that the positive or increased side of a cash account was the left side and the negative or decreased side was the right. That's not true for all accounts. The fancy way accountants refer to the left and right side of the account is debit and credit. Those words come from a Latin textbook written by Luca Pacioli in 1494. It might be time to let those go. A quick trick to remembering which side is the positive side of the cash account is that deposits add to an account. D for deposits, D for debit. And checks subtract from an account. C for checks, C for credit. While I'm here, this is probably a good time to mention that we almost always abbreviate credit as CR and debit as DR. Yeah, I know there's no R in debit, but apparently there was in 1494, so we're stuck with it. While the balance of every account can be tracked using a T account, not every account works like cash with the positives on the left and the negatives on the right. The secret to remembering which side of any account is the increased side is thinking about the sides to the accounting equation. Assets are on the left, and liabilities and owner's equity are on the right. The balance of asset accounts, like cash, should be on the left, just like in the equation. To add to the balance, you'd write the amount on the left, or debit side. To decrease the balance, you'd write the amount on the other side, in this case, the credit side. The balances of liability and equity accounts are on the right. To add to these accounts, you'd credit them. To subtract, you'd debit them. But it gets more complicated than that when we start deconstructing equity. A few accounts increase and decrease equity. When the owner makes an investment or the business earns revenue, then equity increases. Those accounts have normal credit balances. But the accounts that decrease equity, like dividends, drawings, and expenses, will work in the opposite way. Even though they fit under equity in the accounting equation, they have normal debit balances. So what we're left with is assets, drawings, and expenses on the left debit side, and liabilities, equities, and revenues on the right credit side. Over the years, I've seen an awful lot of exam papers with the dealer scrawled in the margin, D-E-A-L-E-R. Let's look at a few examples. If you're new to accounting, I recommend that you indicate the positive and negative side of each account when you first set it up. I ask my students to label the debit and credit sides of each T account and then circle either the debit or credit to indicate the normal balance side. Remember, accounts with a positive or normal balances will have a balance amount on the normal or positive side. So you would set the cash account up as follows. Cash is an asset, so its normal balance is a debit. It increases on the debit side and decreases on the credit side. We've seen cash, so let's set up another asset. Supplies is an asset, its normal balance is a debit, so we increase it on the debit side and decrease it on the credit side. Accounts payable is a liability. Liability accounts have a normal balance on the credit side. You increase a liability account on the credit side and decrease it on the debit side. The capital account increases equity, so its normal balance is a credit. We increase capital on the credit side and decrease it on the debit side. The withdrawals account is a negative equity account. It's a contra account, so its normal balance is on the debit side. To increase withdrawals, you debit it. To decrease it, you credit. Sales is a revenue account that increases equity. Its normal balance is a credit, so you increase it on the credit side and decrease it on the debit side. Utilities expense decreases equity, so its normal balance is a debit. You increase on the debit side and decrease it on the credit side. It will take a lot of practice to get comfortable using T accounts, but remember, they're just a different way to structure addition and subtraction problems.